owner's equity. So I've gone over assets, I've done liability. So here we are in owner's equity. That's the third section of our accounting equation, which is our balance sheet. Right? Our assets equal liabilities plus owner's equity is our balance sheet, right? Those are the accounts that go on our balance sheet. So I put here, because again, I think depending upon where you've taken this class in Intro to Financial, some of you, have you heard of the term owner's equity versus stockholders' equity versus shareholders' equity? Have you heard, or have you only learned like one of those terms? So just to make sure that you've seen all of these, right? Many of you have talked, like your professor probably talked about the issuance of stock. Not all companies work on stock, okay? So if you're not a company that has stock, are you going to have stockholders' equity? No, you're going to just have owner's equity potentially, right? Or owner's capital, right? So this section, so these are terms that they're called. Owner's equity is the same thing as shareholders' equity, same thing as stockholders' equity, same thing as saying equity section of the balance sheet. The terminology just varies depending upon what type of company you're talking about. I should say what type of entity you're talking about, okay? If you're talking about a sole proprietorship or a partnership, you wouldn't obviously have stockholders' equity unless you were incorporated, because then you have stock that you issue. What do I have here? The residual interest in the assets of a company after deducting liabilities. Okay, so this is like a definition. This is a definition of owner's equity. This is a very technical definition. The residual interest in the assets of an entity after deducting liabilities. Right? It's like just an equation, right? Assets equal liabilities plus owner's equity. If you subtract liabilities from each side, you get assets minus liabilities equal owner's equity. Therefore, owner's equity is equal to what's left, assets minus liabilities, which is what's left of your assets after deducting liabilities. That's just a very technical definition, right? Another term for that would be net assets, okay? You'll hear that a lot. So equity is made up of, these are 4 really important things. Again, places I think that may be confusing to people, particularly if you haven't looked at this stuff in a while, okay? So if you're looking at a balance sheet, in the equity section, you will see the following, depending upon the kind of entity that it is. You may see common stock. You may see additional paid-in capital. This has to be if you are a company that has stock. Retained earnings. What goes into retained earnings every year? Net income folds into retained earnings at the end of every year and accumulates there. So it's not just one year's net income, it's the net of all of your net income and losses over all the years that you haven't distributed. There's something called accumulated other comprehensive income. We're going to talk about that more. I think we touch on it in this class. You're going to talk about that more in future classes, for sure. It's AOCI, accumulated other comprehensive income. Distributions to owners are dividends, or dividends, depending upon, right? It's dividends if it's a corporation, but a partnership can make distributions to owners as well. And that also comes out, it becomes a reduction to the total in the equity section of your balance sheet. Okay, so these are all terms that you will commonly hear in the equity section of the balance sheet. Okay? Any questions on what I've talked about so far? All right, so we're going to go through a few more slides here, and then we're going to play a little game thing, a little exercise game. Okay, so yes.
Some things is not on the slide.
Yeah.
Will we receive the whole thing, or?
You didn't. Some things are not on the slides.
Yes.
So you should. So the slides I send to you are not complete. You have to fill in stuff. It's to help you to help you pay attention, right? So the slides are not complete. They leave things out, so you need to pay attention so you can fill in what's in the slides. You should be writing, yes. If you haven't gotten that already, you should notice that there are things missing in the slides, right? Because that's one thing also. It's like as I teach here longer, I start to notice different things, right? If I give you all the information, then you don't write. And in my experience, writing helps you remember and helps you learn. So I want you to write, so I'm giving you some stuff, because I don't want you to have to write all of this, right? I've also tried giving nothing, and then everyone sits there like, can you please not change the slide? And it becomes like very monotonous. So this is where I'm at now. Yeah?
So can you just go over distributions one more time?
Yeah, so distributions to owners. If an owner, you have owner's equity, right? You have the owner's equity section, and you have retained earnings in that section, right? That's the net income that accumulates over time. Companies may just decide to give dividends, right? Dividends are giving out some of that retained earnings. You make a distribution on your based on the net income, right? So where does that come out of? It's all part of this section, okay? So distributions to owners, except whereas other things like net income increases the equity section, distributions to owners decreases it, right? That's for a corporation. If you are a partnership, partnerships make money during the year and their capital accounts go up or down. You know, I'm Rebecca Block, comma capital. If we made $100,000 during the year and I was 50-50 partners with you, what's your name? Basil. Basil? So Basil and I are partners. We make $100,000 during the year. We take $50,000 each. I say, it's nice that it's sitting in that bank account, but I'd like that in my bank account, so I take out $40,000 of that. I leave $10,000 in, maybe for future investments in the company, right? I take $40,000 out. That's a distribution to me as the owner. Where would that make sense to come from? My equity, my Rebecca Block, comma capital account should go down by $40,000, right? It's a distribution to owner in the equity section. I just realized I never took attendance. Lucky you guys. I'll take it right after the break. So, yes.
A company like Ernst & Young, per se, when they have like 1,000 partners, do they all have that?
They have capital account balances that then that are maintained, and if they take distributions, then that would reduce their capital balance. Okay? So, all right, any other questions about that? All right, so more about equity. Equity accounts should have a credit balance normally, right? Just like liabilities, except if you have losses, right? If you post a net loss to retained earnings, over time, cumulatively, you have a net loss in retained earnings, then it will have a debit balance, not a credit balance. So most of the time, you would hope that your equity accounts have a credit balance, but that's not always the case. Sometimes they show negative, right? Which means they have a debit balance. They're also permanent accounts. Anything on the balance sheet is a permanent account. So here, revenue and expenses, which are temporary accounts, they go away at the end of the year, but they really fold into the equity section. Okay? They're gone, they're in retained earnings at the end of the year. Okay? So they fold into the equity section at the end of the year.